Here is what Tom Lee said today on CNBC following the Nasdaq's 1.5% rally.
Who's here? Tom Lee, Fundstrat Global Advisors co-founder and a CNBC contributor. I was thinking, who would I like to talk to? And here you are. There are some reasons that you think maybe we're nearing the end of whatever you want to call this, this tough period for the past 2 weeks.
Yeah, it's been a painful 2 weeks. I think some of the ways to think about why we're near an end is inflation expectations have way overshot to the upside. 1 year forward inflation is at 4.5%. It's where it was in October 2022, March 23, October 2023. So at the peak pessimism.
That's one thing.
Yeah, short interest has soared. Like 1 week, Goldman shows 1 week short interest in ETFs rose by the most since 2022. Median short interest in stocks is at basically a 3-year high. We're really oversold. If you look at internal measures like the percentage of stocks over their 20-day moving average, it's down to 8%. Again, a turning point. And now we just need a positive catalyst. I think as long as inflation tracks better than expected, I think we're in a good position to rally.
You look at different things in Katie Stockton, obviously. She said that there has been some damage, therefore she thinks there's maybe some more work. Not a whole lot more work, but maybe some more. Do you look at that? Has there been some damage, or do you see all positive indicators as far as maybe we're getting close to the end of the beginning of the end, end of the beginning?
Yeah, I think probabilities probably is what she's looking at, and I think there has been a lot of damage to the markets, but there are ways to look at why things could be turning. Mark Newton, our head of technical strategy, says the cycle turn date he was looking for is April 20th, and that's
420.
Yeah, 420.
Perfect.
And if you look at things like the DeMarc count, we're at almost a 7, so we're only 1 or 2 days from a potential bottom or turning point.
And we're oversold. We actually got oversold really quickly.
Yeah.
I don't know why.
Well, they say bull markets rise in an escalator, fall in an elevator. So it's what you'd expect in a rising trend is sharp corrections, and it shakes people out. And I think there's a lot of top callers, but to me, I think this is a good opportunity.
So also the day before 420, did you know 42024 is frontwards and backwards?
Oh, it's a palindrome number?
Certainly is. But the day before was the halving. And what does that mean to you for your Bitcoin
it's a reminder of the sound money of Bitcoin, right? Because it's pre-programmed every 210,000 blocks to cut the block reward. We know it means you're cutting supply, but demand has been strong, and actually Bitcoin network usage has really been strong because of things like the Brune protocol. So you've kind of made the demand side stronger and the supply side smaller, so I think it's upward pressure on price.
So you always have crazy forecasts. What's your forecast now? And I'm doing something while you're doing it.
Yeah,
What's your forecast?
well, I think Bitcoin definitely makes new all-time highs this year. So we think something like 150,000 is probable this year. And then longer term, I don't think there's anything wrong with those targets people have, like 500,000 for Bitcoin or much higher.
I was opening this for Andrew because first thing I read this morning was up the dirty money flying under the billions. And I kept looking for the B word. And it's just not anywhere here. Not one thing about Bitcoin being used for the money laundering. So it can be done without Bitcoin, I guess.
Yes, I think that money launderers have successfully used other currencies.
Since the beginning of time. We always point that out,
and
right?
Commodities,
collectibles. I think it is good. I mean, ransomware is always Bitcoin, and that is the nastiest kind of I think, extortion. So, I mean, there can be some uses, but you can use cash, right?
And use cash.
Did you see that? You saw that. Did you think about me? I thought about you when I read that.
So as you heard, Tom Lee is bullish on stocks. That's probably not a surprise to anyone that follows Tom Lee and or Fundstrat. They tend to be more positive than negative, and that's why they tend to do well, because stocks tend to go up over time. But here in this video, we will break down the intricacies of our markets. What looks good? What looks bad? And try to come to a conclusion of what's coming next for markets. So I think the biggest thing that is really screaming to anyone that pays attention to technicals is just how aggressive this sell-off was. Last week, the NASDAQ fell almost 5.5%. The last time the NASDAQ has fallen 5.5% in a single week was back here during June of 2022, as well as September of 2022. These were both over 5.5% drawdowns in a single week for the NASDAQ. Now, what tended to happen after both of these was another almost 5% pullback the next week. So judging off of this historical precedence that we have seen in recent times, it would suggest maybe more downside could be coming for markets. But then again, the markets have been so bullish recently, this aggressive drawdown has caused the RSI to actually go under 30, to be technically oversold in just 1 week. Now, anytime in the past couple of years, when you get to about 30 on the RSI, you tend to get a bounce in the markets. Now, it doesn't mean the selling is over with, but it does usually coincide with a decent bounce for stocks. And I talked about this in the last video, that even if we do get more downside from here, we're likely to get a period of time where markets bounce and even trade sideways, kind of consolidate for a period. But by far the biggest thing that will drive markets higher or lower is earnings. You guys have to remember, the bull thesis right now is pretty stretched, okay? So if the bull thesis is as followed, the economy is strong, people have jobs, people are spending money, and that's going to drive earnings growth at the S&P 500. That is the bull thesis for markets right now. So I would say this has been a relatively weak bull market compared to what we have seen in prior bull markets. Even to start 2024, you had inflation falling, you had the Fed that was going to cut rates multiple times in 2024, and you had earnings growth that was expected to be strong, up over 10% year over year for the S&P 500. You've lost the two. You've lost inflation falling, and you've lost the Fed cutting rates multiple times in 2024. It's always possible that we could see progress on inflation, that we could see the Fed get more dovish, but as of right now, the markets and a bull market, presumably, it really only matters what happens with earnings. Now, obviously, if the Fed does get more bearish, if inflation comes in higher for another month or two, we could be talking about the Fed needing to raise rates again, and that would clearly be a big negative catalyst for stocks. But we're not quite there yet, so in the near term, it's all about earnings. This week, we will have important earnings. Today, in after hours, you will get Cleveland-Cliffs, SAP, and Cadence, as well as AGNC, Ameriprise, Globe Life, MedPace, PCA, and Alexandria. Not really anything notable here. You do have Cadence, and they were referenced by NVIDIA, so they are grouped into that semiconductor category. If Cadence has good or bad earnings, that could affect the rest of the semiconductors, and given what happened with semiconductors last week, it was not pretty. Today, you are seeing a bit of a bounce there. NVIDIA is up 4%, AMD is up 1.5%, ARM is up 7%, SMCI barely just now going green. And last week's semiconductor glut, if you will, or sell-off was because SMCI did not give guidance. Tomorrow morning, you will get GM, UPS, GE, Pepsi, Lockheed Martin, Spotify, RTX, JetBlue, and Halliburton. Tomorrow and after hours, it will be Tesla that will dominate the headlines, Visa, Enphase, Texas Instruments, Baker Hughes, Weatherford, Mattel, Wednesday pre-market, Boeing, AT&T, Humana, General Dynamics, Boston Scientific, and Biogen. Wednesday after hours, you will get Meta, IBM, Ford, Chipotle, ServiceNow, Lam Research, and Align. Thursday pre-market, Royal Caribbean, one of the best performing stocks in the S&P 500 last year, American Airlines, Newmont, Altria, Caterpillar, Southwest, Bristol Myers, Mobileye, and AstraZeneca. And then Thursday and after hours, your biggest day for market cap weighting, it's Microsoft, it's Google, Intel, Snap, Roku, Western Digital, Dexcom, T-Mobile, Gilead, and Aginco Eagle. And then Friday, you have ExxonMobil, Chevron, AbbVie, Colgate, some other healthcare names as well. Now, I will say, if you are a bull, okay, last week, set you up in a little bit better of a position for big tech earnings. Because if stocks are ripping at all-time highs heading into earnings, then it becomes a lot harder for markets to be impressed. The valuations are higher. You need to see just overall better numbers. Now, Microsoft has fallen from their all-time high about 6.3%. A lot of that happened last week. If you take a look at Meta as well, Meta has fallen about 8.5% from their all-time high. Most of that happened last week. Google, well, not so much of a decline. Google has only fallen about 2.5% or so, 3% or so from their all-time highs. And again, a lot of that happened last week. And Amazon, which does not report earnings this week, also fell something similar, around about 2.5% last week from their highs. So from that perspective, you're a little bit better off heading into earnings season. But you got to remember, these stocks, these big tech stocks, they're still trading at most of them double what they were during their October-November lows. So expectations are still high. The thing that really matters for our markets is not this quarter earnings. This quarter earnings, I'll be surprised if they come in weak. You see Netflix, they beat EPS estimates by 80 plus cents. They added a bunch of subscribers, but their next quarter guidance came in light. That's what is going to dictate what happens to these stocks and to our markets. The markets don't care about what happened over the past 3 months. They care about what's going to happen 3 months or 6 months, 9 months, 12 months from now. So it's all going to be about forward-looking guidance. I also think AI will be a big focus of this earnings season as well for companies like Meta, Tesla, Google, Microsoft that has spent billions of dollars on NVIDIA products, NVIDIA GPUs, and other companies' products. Are they going to be able to actually make a product to bring in any money? There was a quote, I can't find it now, but somebody said these companies are spending billions of dollars on products, on investments to maybe bring in millions of dollars. Like there's just nothing these companies are using these semiconductors on right now. And semiconductors have been a vitally important part of our markets. So if you do see big tech names start to say, hey, we're slowing down our purchase of GPUs, even if they have good earnings or give you good guidance, the overweight that investors are in semiconductors, that could still be a net negative for markets. On a technical basis, the only thing that really matters to me right now is whether or not you get above this 100-day moving average, this orange line here. If you find resistance here and fall back down, I mean, that's not the end-all be-all for any kind of bull market rally here or, you know, trying to retest the highs for anyone that wants to see that. But you want to get above that 100-day moving average. If you do, that's a lot more of a clear sign that you are going higher. But until we get there, I think there's a little bit of resistance from 420 on the NASDAQ, which we are at right now, up to that 100-day moving average currently at $422.38 per share. If indeed you do get bad earnings or bad guidance from big tech and or your AI stocks in this week and the next couple of weeks, then you fall back down to that, well, 200-day moving average. That is currently sitting at $395 per share. But I also want you guys to keep in mind, if you think about the markets like I do most of the time when it comes to earnings, based on expectations. One area of the markets is priced for near perfection. That's big tech, that's AI. The other part of the markets, small cap, mid cap, or random stocks, they're priced for really nothing great, okay? If they have good earnings, if they give you good guidance, individual stocks could do very well. You can also see the percent of stocks above their 50-day moving average today is up about 20%. 6.08% of stocks are breaking above their 50-day moving average today. And you actually seen about 4% of stocks on Friday breaking above their 50-day moving average at a time in which the NASDAQ was down about 2% on Friday. So you have actually started to see a broadening out of our markets as big tech and AI sold off. So it is possible, even if big tech and AI have bad earnings, it could be a tale of two markets here, where the bottom quadrants, let's just call it medium grade stocks, lower grade stocks can start to do a little bit better. And then your top quadrant, your AI, your big tech, your magnificent 6 stocks, 7 stocks, whatever you guys call it nowadays, they start to fall. That also wouldn't surprise me, and that's kind of the trend that we have started to see. I will also say that 10-year treasury yields are currently sitting at 4.63%. They've rallied a lot recently, and if we do get good economic data this week that suggest, suggesting maybe the economy is slowing down, maybe inflationary pressures are slowing down, you could see a fall in 10-year treasury yields, I think a little bit easier than a rise at this point. You've almost risen 1% for your 10-year treasury yield in 2024 alone. I think the odds are maybe we do start to see a softening here. Maybe the recent trend in inflation kind of moderates a little bit, and that could mean some downside for 10-year treasury yields. And that could be bullish for markets also. So if you are a contrarian bull, this is something I would look at and say, hey, odds are 10-year treasury yields fall from here. Greater odds at least. They could rally, of course, but greater odds that they do fall from here. The NASDAQ did in this latest sell-off end up falling about 8.23%. Tom Lee specifically has been calling for about a 7% pullback in broader markets at some point in the first half of 2024. It seems like that has happened, and I will give Tom Lee some credit there, of course, and say he was right again. There was this, 7+% pullback. And I will say Tom Lee is correct. There is now a greater likelihood that stocks can recover from here. But if earnings do come in bad or guidance comes in bad, then stocks are going to fall more. And I don't even think earnings themselves need to come in bad. If they just come in okay, but nothing that knocks your socks off, nothing that is spectacular, I think that could still mean some downside for big tech. But again, it doesn't mean you need to see downside for broader markets. It's possible markets do what they did on Friday. The Russell was actually green 0.25%, whereas the NASDAQ was down over 2%. Before you go ahead and head out of this video, hit that like button as well as subscribe to the channel. Most importantly, let me know down below in the comment section, are you bullish or are you bearish right now? Do you think more downside is coming for stocks, or do you think now is a good time to be buying the dip? And if you are buying the dip, where are you buying the dip? Are you buying AI stocks / semiconductors? Are you buying big tech? Are you buying small caps, biopharma? Are you buying healthcare, retailers? Where are you buying? I would love to get some insight from you guys. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.